Bitcoin, the world's first cryptocurrency, has come a long way since its inception. From its humble beginnings as a niche technology, Bitcoin has steadily gained recognition as a legitimate asset class. Its decentralized nature and scarcity have captivated investors. However, regulatory hurdles have hindered its mainstream entry. Bitcoin ETFs promise to bridge the gap between traditional markets and digital assets. This development could unlock institutional and retail investment, propelling Bitcoin into mainstream finance. To understand Bitcoin ETFs, grasp the basic mechanics of ETFs. An ETF holds assets like stocks, bonds, or Bitcoin. Shares of the ETF are traded on stock exchanges. Buying a Bitcoin ETF share doesn't mean purchasing Bitcoin directly. Instead, it's a stake in the ETF tied to Bitcoin's price. This structure simplifies Bitcoin investment. No need for cryptocurrency wallets or exchanges. Investors can use their existing brokerage accounts. The path toward a Bitcoin ETF in the United States, the world's largest financial market, has been marked by regulatory scrutiny and delays. The U.S. Securities and Exchange Commission, the primary regulatory body overseeing securities markets, has repeatedly rejected applications for Bitcoin ETFs, citing concerns about market manipulation, custody security, and investor protection. The SEC's cautious approach stems from its mandate to safeguard investors and maintain the integrity of financial markets. However, the cryptocurrency industry has been actively engaging with regulators, addressing their concerns and advocating for the approval of Bitcoin ETFs. Proponents argue that the cryptocurrency market has matured significantly with improved infrastructure, increased liquidity, and the emergence of institutional-grade custody solutions. They contend that a regulated Bitcoin ETF would provide investors with a more transparent and secure avenue for gaining exposure to Bitcoin, ultimately enhancing market integrity. The demand for a Bitcoin ETF has been steadily building for years, driven by a confluence of factors. First and foremost, Bitcoin itself has gained significant traction as an investment asset. Its limited supply, decentralized nature, and potential as a hedge against inflation have attracted both retail and institutional investors. As more investors recognize the potential of Bitcoin, the demand for a regulated and accessible investment vehicle has grown. Secondly, the broader financial landscape has become increasingly conducive to the emergence of alternative investments. Traditional markets have been characterized by low interest rates, geopolitical uncertainty, and concerns about inflation. Investors are increasingly seeking alternative assets such as Bitcoin to diversify their portfolios and potentially enhance returns. Section 5. Market impact, injecting liquidity and fueling price appreciation. The approval and launch of a Bitcoin ETF are widely anticipated to have a profound impact on the cryptocurrency market. One of the most significant effects is expected to be a surge in liquidity. ETFs, by their very nature, are highly liquid instruments traded on major stock exchanges. The introduction of a Bitcoin ETF would provide a new avenue for institutional and retail investors to enter and exit the Bitcoin market with ease. Increased liquidity typically leads to tighter bid-ask spreads, making it cheaper and easier for investors to buy and sell Bitcoin. This enhanced liquidity could also contribute to reduced price volatility, making Bitcoin a more attractive investment for risk-averse market participants. Moreover, the influx of institutional capital through a Bitcoin ETF could fuel further price appreciation, potentially driving Bitcoin to new all-time highs. Section 6. A boon for investors, accessibility, security, and portfolio diversification. The launch of a Bitcoin ETF would be a boon for investors, particularly those seeking exposure to Bitcoin without the complexities and risks associated with direct ownership. ETFs offer several key advantages, including accessibility, security, and portfolio diversification. As mentioned earlier, investors can easily buy and sell shares of a Bitcoin ETF through their existing brokerage accounts, eliminating the need to navigate the technical intricacies of cryptocurrency exchanges. Furthermore, ETFs are subject to stringent regulatory oversight, providing investors with a layer of protection. Custodians of Bitcoin ETFs are required to adhere to strict security protocols, mitigating the risk of theft or loss. This is in stark contrast to direct Bitcoin ownership, where individuals bear the responsibility of securing their own private keys and safeguarding their digital assets. Section 7. The rise of institutional adoption, a paradigm shift in Bitcoin's narrative. The approval of a Bitcoin ETF is widely seen as a catalyst for institutional adoption. Institutional investors such as hedge funds, pension funds, and endowments manage trillions of dollars in assets. However, their involvement in the cryptocurrency market has been relatively limited due to regulatory uncertainty, custody concerns, and a lack of familiar investment vehicles. A Bitcoin ETF would address many of these concerns, providing institutional investors with a regulated, transparent, and secure way to gain exposure to Bitcoin. The influx of institutional capital could have a transformative effect on the cryptocurrency market, legitimizing Bitcoin as an asset class and potentially driving further price appreciation. Section 8. Addressing concerns, volatility, manipulation, and regulatory uncertainty. Despite the potential benefits of Bitcoin ETFs, it is essential to acknowledge the concerns that have been raised. One of the primary concerns is the inherent volatility of Bitcoin. Bitcoin's price has been known to fluctuate dramatically, which could pose risks for investors, particularly those unfamiliar with the dynamics of the cryptocurrency market. However, proponents argue that ETFs, by their very nature, provide a degree of diversification, potentially mitigating some of the volatility associated with individual cryptocurrencies. Another concern is the potential for market manipulation. Bitcoin markets are still relatively nascent and less regulated than traditional financial markets, making them susceptible to manipulation by large players. The SEC has repeatedly cited market manipulation as a reason for rejecting Bitcoin ETF applications. However, as the cryptocurrency market matures and regulatory oversight increases, the risk of manipulation is expected to diminish. Section 9. Beyond Bitcoin, the expanding universe of cryptocurrency ETFs. While the focus has primarily been on Bitcoin ETFs, the cryptocurrency ETF landscape is expanding to encompass other digital assets. Ethereum, the second largest cryptocurrency by market capitalization, is also gaining traction as a potential candidate for an ETF. Ethereum's smart contract functionality and its role as the foundation for decentralized finance, or DeFi applications, have made it an attractive investment for many. In addition to single-asset ETFs, there is growing interest in diversified cryptocurrency ETFs. These ETFs would track a basket of cryptocurrencies, providing investors with broader exposure to the asset class and potentially mitigating some of the risks associated with investing in individual cryptocurrencies. As the cryptocurrency market continues to evolve, we can expect to see a wider range of ETF products emerge, catering to different investor appetites and risk profiles. Section 10. The future of finance. Bitcoin ETFs as a gateway to decentralization. The emergence of Bitcoin ETFs represents a significant step toward the integration of cryptocurrencies into the mainstream financial system. While some may view this as a threat to traditional finance, it can also be seen as an opportunity for innovation and growth. Bitcoin and other cryptocurrencies offer a glimpse into a future of finance that is more open, transparent, and accessible. Bitcoin ETFs could serve as a gateway for investors to explore the broader world of decentralized finance. DeFi applications built on blockchain technology are disrupting traditional financial services, such as lending, borrowing, and trading. As investors become more comfortable with cryptocurrencies through ETFs, they may be more inclined to explore the potential of DeFi, further accelerating the adoption of decentralized technologies. Section 11. Conclusion: embracing the transformative potential of Bitcoin ETFs. The journey toward a Bitcoin ETF has been long and arduous, marked by regulatory hurdles, industry advocacy, and evolving market dynamics. While the SEC has yet to give its full approval, the momentum behind Bitcoin ETFs is undeniable. The potential benefits for investors, the cryptocurrency market, and the future of finance are too significant to ignore. As we stand on the cusp of this transformative development, it is essential to embrace the potential of Bitcoin ETFs while remaining mindful of the risks and challenges that lie ahead. The future of finance is being written in code, and Bitcoin ETFs are poised to play a pivotal role in this exciting new era.